Hello. Welcome everyone to the Insightful Leader Live. I'm Jess Love, Editor-in-Chief of Kellogg Insight. Looking ahead, we have a number of webinars in the works. I wanted to flag one that I'm really excited about. That's a webinar with Kellogg's Carter Cast. Professor Cast will be joining us early in the new year on January 12th to talk about how to help your team or yourself manage burnout. So mark your calendars now if you suspect that you may be in need of some stress relief as we enter the new year. Again, that's January 12th. Today, of course, I'm thrilled to introduce Professor Aaron Yoon. He is going to talk to us about ESG investing. More on that in just a second. First, some housekeeping. We will be closing the chat box in the next couple minutes here, so please leave your questions in the Q&A box. There will be time for some of those questions at the end, and you can also upvote each other's questions, and that is actually very recommended. Closed captioning is available today. You can access it via live transcript at the bottom of the screen. And this event is going to be recorded. You will receive a video via email early next week of this webinar. I want to take us to the main event here. Today, we are going to talk about ESG. And that's a term that refers to a firm's environmental, social, and governmental activities. But if you find yourself struggling a bit with this term, you are not alone. It can mean a lot of different things to a lot of different people, which is only one reason why it's so hard to measure. But lucky for us, Aaron Yoon, an assistant professor of accounting and information management here at Kellogg, has done some pretty foundational work in this area. And today he'll be talking to us about the state of ESG investing and why the next few years could be really critical for the sector. So Professor Aaron Yoon, let me turn it over to you.
Thank you, Jess, for your kind introduction, and thank you everyone for attending. Let me just make sure I share the slides correctly. So I am incredibly grateful to give a quick overview of this ESG space, as well as, do a little bit of fortune telling. I'm obviously not a fortune teller, so the future of ESG may be a little bit of an ambitious term, but my goal is to sort of give you my take on ESG, sort of the state of ESG, and then sort of give you a few thoughts on what I think will happen in the future. So ESG has just exploded, right? A classic example that is quoted in the asset management industry is the United Nations Principles for Responsible Investment. These asset managers and asset owners are signing the UNPRI principle, and they're effectively committing roughly about 50% of their asset under management in responsible investing or ESG investing. The number has grown tremendously, starting 05-06, roughly with a few $100 billion in aggregate. By 2021, the total number of AUM, the amount of AUM of UNPRI signatories, so asset managers as well as asset owners, have exceeded 120 trillion US dollars. So it is a magnificent amount, right? Because US market cap, depending on the day you look at it, is roughly about 35 trillion. So roughly 3 times the entire US market cap has committed to incorporate ESG information into their decision-making process. And at the same time, almost all firms are claiming that they are engaging in ESG issues and valuing ESG as a very important investment activity. To give you some sense as to how sort of the disclosure phenomena as well as firm commitments on ESG has grown, this is a quick graph by G&A Institute. And this points out that by 2020, roughly about 90% of S&P 500 firms are pushing out ESG reports like sustainability, CSR, ESG reports, claiming that ESG is a very important investment activity of those firms. So ESG is so, hotly debated, right? And there are a lot of political issues that are sort of intertwined, but setting that aside, there has been a very rich debate on ESG that relates to shareholder primacy that I wanted to sort of open up and share with you guys. So Milton Friedman, a Nobel laureate, is often quoted or misquoted by this Freeman doctrine, saying that the social responsibility of business is to increase its profits, right? So he's quoted this way, and people have sort of cornered CSR or ESG to be counter to shareholder primacy, or that doesn't enhance or is irrelevant to shareholder value. On the other hand, in 2019 summer, a group of CEOs, so CEOs of the largest 200 roughly US companies, the Business Roundtable 200, came out with this bold statement saying that shareholder value is no longer everything, and companies should now focus on creating long-term value as well as creating stakeholder value. So this caused a furious debate, and that's sort of the debate between shareholder and stakeholder value as of now. So it makes me and us should wonder, why would these CEOs make such a statement? Are they just very righteous? They care about the society, which is partially that, right? But and how can we make sense of the firm's ESG efforts? So with that in mind, let me give you some additional color on this space. So in order to understand these two questions, I think it's very important on how we analyze companies in a traditional sense, right? We teach our corporate finance and financial accounting students that there is an input of firm resources and there is output of revenue or cash generated to the firm, right? So the question with any type of investment activities that firms make is, how do we analyze companies and identify good investments, right? And there will be firm level sort of characteristics and covariates that shape this relationship, right? And a classic way to analyze companies is through the discounted cash flow model. One very classical way that financial analysts and investors use, and how they back out or infer current value is to conjecture future expected cash flow, which is largely based on financial statements, the three financial statements, and the growth assumptions that an analyst would make, divided by the cost to borrow money from shareholders and debt holders. So here I wanted to note that current way in which analysts or investors infer the current value of the company is largely based on financial statement numbers, plus some assumption about how much it will cost the firm to borrow money, right? So how would a CEO maintain the current expected value of the company or the share price of the company, which is tied to the person's compensation, right? Either the CEO could really work hard with the company members and employees to grow the future expected cash flow, right? Or to reduce the cost of money that they can borrow from shareholders and debt holders. So to put this in context, given that almost none of ESG information is in the financial statements that impacts the future expected cash flow assumption, right, other than growth, it could be possible that these CEOs who are only for the shorter term, right, like 3, 5, maybe 10 years, to talk about ESG issues or stakeholder-focused issue to reduce the cost to borrow money from shareholders and debt holders. If you reduce the denominator, you will be able to increase the current value, right? Or you can increase the future expected cash flow through growing the operations and also increase the current value, right? So just to sort of put a critical lens as to why these CEOs may be engaging in these talks, because at the end of the day, right, CEOs are in the business of delivering for shareholders. They're fiduciary agents for shareholders. So I want sort of us to at least think about some of these issues and the incentives that that shape how these CEOs bring out these public statements. So a very big question in ESG investing is, how can investors use ESG information, which is oftentimes not readily available in financial statements that are audited, to inform their portfolio decision-making process, right? So I wanted to highlight first that there are some frictions. So there's a flood of ESG information, right? From 2011, only about 20% of S&P 500 firms issued some type of ESG information out there. 2020, 90-some%, right? And 70-some% of Russell 1000 companies are pushing out ESG information. But there is little regulation on ESG information. This is a Wall Street Journal article that was just about 6-7 months ago, that was released 6-7 months ago. And it's pointing out that countries are now ramping up rules regarding ESG disclosure. So we can quickly tell that a lot of the ESG information that firms are disclosing are unaudited, and they're voluntarily disclosed to promote companies potentially, right? Let me give you sort of one example on a very interesting ESG report. So this is a 2013 sustainability report from Home Depot on the left. And on the right, there's 2014 sustainability report from Home Depot. Who can tell me the difference? They look very, very similar, right? Almost they look identical except the year. So if we look at the content of this, it gets a little bit more striking. So they give you an overview, both 2013 and 14. It's very difficult to tell whether they're just changing the years or what's actually in there, right? So to give you another deep dive, this is a page 17 of 2013. They claim that they talk about an $80 million number, right? Committed to veterans housing initiatives. This is a wonderful initiative, right? But if you look at 2014, they have the same identical 80 million committed to veterans housing initiatives. So what is this causing in an unregulated disclosure space? Are they donating 80 million every year, which is a very large number? Or are they have committed? It's very uncertain, right? So this causes a lot of frictions and problems for investors to really make sense of firm ESG efforts and how they are related to shareholder value. So there's the rise of ESG raters, right? So because ESG investing has been sort of classified historically as value irrelevant or value destroying, not many financial analysts, like traditional brokers on Wall Street, have jumped into ESG. It's only recent that these folks have. So you have these folks like MSCI, Sustainalytics, S&P, CDP, FTSE, that has been in the business of ESG, producing ESG rating for 10-some years, and some of them longer. And Wall Street Journal article pointed out a very interesting phenomenon. So they took a very large ESG raters, Sustainalytics, FTSE, and MSCI. And for these major companies, they looked at the overall scores, environmental, social, and governance score by these three vendors. I mean, they're sort of perceived as the larger ones for sure. For example, MSCI has 31% of the global market share right now, so it is a very dominant player. But you notice that there's a huge disagreement among ESG raters on governance, which, for Tesla, it's less debated, right? Because there's only one person that you need to focus on. But for Exxon or GM or Alphabet, there's a little bit more disagreement. For environmental issues, obviously there's a huge disagreement. This is, to some people, very surprising because environment, when you think about it, is carbon emission, right? So it's a number, but there's still a big disagreement. And social issues are very hard to define, and oftentimes there is a lot of disagreement, right? So this is a very interesting and newly sort of flagged phenomena in this space, and I would largely attribute this to this unregulated nature of ESG information. Because, I mean, if I ask folks in this room, I'm sure I'll get hundreds of different definitions as to what ESG means to them and what it means to shareholder value, right? So with that in mind, I wanted to point out that, you know, these big ESG raters are being accused that they don't try to measure impact on the world. And it's just all about the world, you know, how it, you know, mess with the bottom line. So we're not even at an agreement as to what these ratings should fruit to. Should it be impact, which is another sort of very hot new topic, or is it value, or is it risk, or is it some negative events? So we're in this weird space where people talk about ESG risk, and every single ESG raters claim that their goal is to predict or forecast future ESG risk, but we don't really have a sense as to what ESG risk is at this current day that we live in. So what are the problems that can arise against this backdrop, right? So the first backdrop is there's a debate in the value relevance or shareholder value relevance of ESG or CSR or SRI issues. And second, there is this unregulated nature of this ESG information that is not yet audited, right? And put it in a formal financial statement, right? An obvious problem is greenwashing. So let me start sort of blending in some of my academic research and to give you some sense as to what is going on or what I have observed is going on using archival data. So I have a recent paper titled Analyzing Active Mutual Fund Managers' Commitment to ESG, Evidence from the UN Principles for Responsible Investment, which is that big, large first graph that I showed you guys. And I wanted to first start out noting that major funds, like asset managers and investors, proudly advertise that they're valuing responsible investment, and they have joined this UN initiative. And you know, they oftentimes have a sole website page dedicated to it, or either a front page of their you know, website has a big logo, or in the prospectus it's mentioned, etc. And these funds, what I find with my co-author Suhan, is that they attract a huge increase in quarterly fund flows, which determines how much they are compensated, right? So after committing to UNPRI principle, and they advertise quite, you know, actively, and they're proud of this, there is a huge spike in fund flow. So they're attracting more capital from asset allocators like, you know, CalPERS, you know, TIA, CREF, you name it, right? And this timing with respect to the UNPRI signing is quarters. So they enjoy, I would say about 5 to 6 quarters, they enjoy a sharp increase in fund flows. But using, for example, MSCI ESG score as an indicator to a metric to create a fund level ESG score, we observe effectively no change in fund level ESG performance. There also is no improvement in fund return. There's actually a slight decrease. So what this paper has shown is that because ESG is so hard to agree on and there's no regulatory scrutiny, these funds attract more capital, but there's really no follow-through ESG performance as well as return. So it could mean a few things, right? First, it could be that these fund managers are greenwashing or trying to use this as a marketing tool. Second, it takes time for them to incorporate ESG into their decision making. Our paper is slightly agnostic on that, but at least using 6 quarters post signing UNPRI, we didn't find any sort of meaningful follow through in fund level ESG performance. So how can investors, like these signatories, use ESG information to inform their portfolio decisions? Because when I showed you this DCF, which is anchored on financial statement numbers, which is a very classic way in which you analyze companies as an investor, what are the alternatives? And the alternative is effectively creating a long short portfolio like a hedge fund using some type of signal, right? Like a quant fund would do. So, we talked about how these, so current research, which my research is based on as well, inevitably uses ESG raters, right? Because there's no other signal that I can use in aggregate. But we talked about this problem, right, of very sort of, a lot of disagreement among ESG raters. So this first makes us to question, are ESG signals useless? And I think the buzzword in the media, as well as all across, is that ESG ratings are useless. They're highly disagreed. But I actually think that it is an opportunity for a person like myself, who's an accounting academic, who's in the business of accounting for things, as well as investors, right? And I think this particular graph shows you that it may not be useless, at least at the cross section, right? So this is a consulting firm called Opimus, I think. I don't want to butcher their name. They've gauged how fast ESG data market grew. It really grew very fast in recent years, and this market is $1 billion plus market. So it's really not a small market that could be dismissed. And these clientele, the clientele of these ESG raters are mainly almost exclusively institutional investors. So in that sense, when we think about a rational market, why would these investors pay for these, right? Because they want to enhance their ESG signal by using these data provided from these ESG raters, right? So back to the basics, right? How I am viewing ESG, which could be a pretty unique view in some sense in this current market and academia, is that ESG is an investment activity of the firm. There's no doubt that ESG activities of the firm uses up resources of the firm, right? In order to prepare ESG disclosure, you need money and you need the legal folks, you need to hire people to create beautiful PDFs, etc. If you want to install, filters to reduce GHG emission, you also need capital, right? You need cash. So I'm viewing ESG as an investment activity, and my leap of faith that I'm making through my research is that it will inevitably be tied to some type of output that firms generate. How do we tease it apart, and what are the firm level covariates that shape that sort of link between shareholder value and firm ESG efforts? So I wanted to introduce 2 of my academic research as well. First one is titled Corporate Sustainability, First Evidence on Materiality. It's about a 6-year-old paper now. So the key insight of this particular work is to separate pre-existing ESG signals that encompass all of the firm's ESG efforts into 2 things. So one that is related to the firm's core business practices, and I'll give you some examples of that very soon. And 2 is one that is not related. So first one is called material ESG investments in sort of this ESG lingo. And second one is immaterial ESG investments. And what we find, me and my co-authors, is that firms can create value to shareholders when they invest in ESG issues related to their own core practices, and they also exhibit higher sort of return on sales and all these things. So why is this? So I wanted to briefly explain to you what happened before this particular paper. Most, if not everyone, has been using an ESG signal that lumps the two, created long-short portfolios because none of this is financial information for the most part. Didn't find the difference between top ESG or CSR performers and then the bottom, and effectively concluded that ESG is not related to shareholder value. So let me sort of show you some results. Oh, actually, to give you a quick sort of color on what the financial, material, and immaterial ESG investments are, if you think about an oil and gas company like British Petroleum, investing in ESG issues that reduce greenhouse gas or prevent water damage or oil spill, that would be an ESG investment that is related to the firm's practice. Let's imagine a big bank loving the environment and telling their shareholders, we have to move into a new building that is LEED certified platinum. Those ESG issues would also consume firm resources, but it is irrelevant to the firm's business practice. And this SASB, which is Sustainability Accounting Standards Board, which is now part of the IFRS's ISSB, so International Financial Reporting Standard Board's sustainability arm, effectively teases out which issues, or at the high level, gives you which issues are financially material or to the particular firm in the sector, which issues are not. So for example, non-renewables, you have emission issues. The darker ones are more financially material. White ones, like customer welfare, data security, those are the immaterial issues. So very similar to the example that I gave you with oil and gas and a bank. So what we do is the following. So we create this material ESG investment signal and buy the ones that are really high and sell the ones that are really low. So effectively like a quant long short hedge fund type of strategy. We start with $1 in 1993, which was the first year in which this signal was available to us, and rebalance that portfolio every year. So I'm effectively holding that portfolio of good firms and shorting the firms that are bad on, material ESG issues, rebalancing every year. And 20 some years later, there's a stark difference in the portfolio performance of these two groups, which suggests that when firms make material ESG investments, so those issues that are more close to their core practice, they actually create future stock returns for their shareholders or value for their shareholders. When we use the immaterial signals, so ESG investments that are unrelated to the firm's core practice, and do the same exercise, put $1 in 1993, hold it for a year, rebalance every year, there isn't really much of a difference in the portfolio's performance between the high and low group. We also do a little 2x2. So our purple, Kellogg's color, of course, are the smart ones. So firms that are high on material and low on immaterial. So arguably those firms that understand the value relevance of these ESG issues. So those firms that invest both in material as well as immaterial ESG issues, they're just going all out on ESG. Dumb, those are opposite of smart. They're low on ESG issues that are core to their practice, high on those that are not, and none. So firms that are very shy on investing in ESG issue, the shareholder value creation implications are drastically different between smart and the three groups, which suggests that understanding this, materiality, sector level materiality, so is a very important thing in ESG investing. My second paper, which is more recent paper, is titled, Do High Ability Managers Choose ESG Projects That Create Shareholder Value? Evidence from Employee Opinions. So the key insight of this paper is very intuitive. High ability managers choose ESG projects that create value for shareholders. And the why is because, in my opinion, high ability CEOs compensation or CEO compensation is tied to shareholder value or price, right? Stock price in general. So let me show you how I execute this particular project. We get this ESG performance signal from MSCI again, which is the largest ESG provider. And then we look at the firms on the x-axis. We separate the firms in two groups. High senior manager ability proxied by employee ratings, and then those that are low. And in the four quadrants, I'm putting annualized excess stock returns, which is alpha, and firms that are high on ESG, so which is a proxy for firm level ESG investment, given that we don't know exactly how much they're investing in this space. And high senior manager ability generates roughly 5% excess return to their shareholders each year. All the others either do not generate meaningful returns or generate negative returns, which suggests that the role of CEOs is a very important part. I mean, of course, because they're in the business of making decisions for the firm, right? In picking ESG projects that could create future returns, short and long. So how do we do this? Is through the Glassdoor data. We're working with roughly 1 million employee observation across S&P 1,500 companies. And as you may have used this before, it's a get to give model, and an employee could rate on the firm's overall career opportunities, comps and benefits, work-life balance, senior managers, and culture and value, all of which are very highly correlated. We use effectively all of them, but our focus is on the senior management and overall rating. One very interesting thing that I want to highlight is that the correlation between ESG score and the employee satisfaction is almost zero. This is a very shocking thing, right? Because people would immediately think that employee satisfaction would be related to ESG, especially S. But in the data, it's actually not the case. So what does this mean, right? It means that there's a rich opportunity to better sort of measure many different ESG issues. And also it gives a food for thought on how to sort of regulate ESG issues and define ESG issues and the components that go in an ESG activity. Anyhow, to sort of put that 2x2 into this graphical format, this is what happens. When you put $1 in, again, to both portfolios, the high portfolio is high ESG investment, high CEO ability. Low portfolio is low ESG investment, low CEO ability. Just in about 8-9 years or so, the return implication or value creation implication to shareholders is almost double. There's a huge difference, sort of highlighting the role of CEOs and the importance of senior leaders as well as employees in this process of ESG. So what is ahead of us? People have thought that ESG is closely related to firm type, which I think is very true. I think ESG is an indicator that indicates firm culture, the management quality, etc. And where I see the real value in ESG, given that every single firm that I know that are major players, or even Russell 3000 firms, are claiming that they invest in ESG issues, is the following. When market's going up 15% a year, which is the type of market that we have experienced for the past 14 years or so, up until 2021, right, where markets has been going up through quantitative easing, ESG is very hard to disentangle the value implications of ESG, especially because folks who allocate capital to asset managers, like our 401k money, could say that, oh, I would rather make I would be happy making 14.5% rather than 15% and do something that is good for the society, right? But during this market turmoil and downturn, I think highlighting ESG issues that create value for the firm, which is to the shareholders, right, effectively, is very important. There are a few very important agenda items that, in my opinion, would be very worthwhile. Should we define ESG? Is a big question, right? We know from EU taxonomy that the regulators, for example, have been sort of very interested in this space, right? But ESG's materiality is likely very dynamic. I mean, I showed you this Sustainability Accounting Standards Board sector level guidance, but ultimately, and in reality, this would vary at the firm as well as time, right? We just can't regulate firm time. We can only kind of, give these firms a high level guidance, right? And do we tackle this one by one, right? So Economist wrote a very interesting article recently saying that we should look at E first and E is the most important, which is, I think a very good argument. So is ESG going to be separated into E, S, and G or some other stuff? I think it will be something of a very interesting thing to observe, how market and the government, the regulators will evolve. How do we disentangle ESG performance and disclosure? I think this is a very important question that we don't have an answer to right now, because, how do I treat a firm that don't disclose an emission? Is that in the middle of the pack, or are they worse performers and they're not disclosing because they're scared to be penalized? A lot of these things are very important, not just from a corporate disclosure perspective, but also from an investor perspective that analyze ESG information, and who, for example, want to transit into net zero sort of a geared portfolio. How much should the regulators step in? Are regulators capable of stepping in? Is another very important question. Recently, SEC has talked about regulating scope 1 and et cetera. Who would have thought that we would get this much pushback, right? Even the most quantifiable, except the G, of course, of E and S issues. So there's a long way ahead of us in terms of, regulating, ESG information, in my opinion. Or do we let the capital market figure it out and the invisible hand kind of sort it out, right? But it'll take time, as you have seen through this, greenwashing papers, right? Because asset managers as well as, company managers may have their own incentives in addition to caring about these important issues, right? Should the regulators actually regulate ESG activities like actual emission, or do they just require ESG disclosure and have the capital market figure out and penalize and monitor, et cetera, is another, I think, very important question. And who? ESG raters, which disagree on almost every dimension, investors, financial analysts, assurance providers, auditors, can better digest ESG information, and under what circumstances they can do that is also crucial, I think, given that most of ESG information are not in the audited, regulated financial statements. So in order to overcome these issues that I've just presented, and acknowledging that ESG is a very fast-growing area with many moving dials, I think it's very important to acknowledge that ESG is an investment activity of the firm. I mean, Milton Friedman, he's often quoted and misquoted that firm managers' duty is to optimize, shareholder value. But if all managers are forced to engage in ESG issue, whether it is because of NGO pressure or government pressure or pressure from investors, who does it better and why are they doing it? And how do they justify that use of shareholder resources? I think is a very important question. So that's sort of what my research agenda is, to identify the link between firm ESG efforts and shareholder value. And I'm so grateful to be able to share some of my thoughts as well as my research, and really look forward to the questions in the audience.
Thank you so much. All right, well, yeah, let's get started with some questions. So we did have a participant who wrote in to say that they feel that the definition of ESG is, not just ask 100 different people and you'll get 100 different answers, but like ask them one week and they'll tell you this, and ask them next year and they'll tell you something different. So it's really hard to get your hands around. But it kind of struck me in your presentation that is it possible that an obstacle to kind of finding a standardized measure of ESG could be the fact that different investments are material and immaterial in different industries and for different firms? Like, is the very nature of ESG and how it differentially affects firms going to potentially stand in the way of the standardization that I think you and many others are calling for?
So I think this is a wonderful question, right? Because the biggest pushback of EU taxonomy, or the SFDR, of defining ESG issues is precisely because of this reason. Tesla didn't exist 15 years ago. Now it's one of the largest companies that has one of the largest impact on the world, right? In terms of the business model, or how the CEO communicates things, etc. How do we gear towards preparing? Because regulation is often reactive rather than proactive, right? So how do we create a proactive environment, or an environment that could facilitate this dynamic nature of ESG, is a very important question. Of course, regulators may have to prioritize on certain issues that impact, our lives. For example, climate change, maybe. So they need that priority in terms of time. But I really don't think there's a right or wrong answer to this. But it is for sure, very, very dynamic thing, right? And that's why I think that, at least in the US, and even so in other jurisdictions, we really need to focus on ESG issues that deliver company value or enhance company value. Because if we give too much power to companies, there will be also problems, right? So who will, at the end of the day, advocate for the social welfare is this question, right? Of, do we give a lot of power to companies, or do we let the regulators handle it, or is that a collaboration? So it's a very important question that I obviously don't have like a full answer to. So let me just stop at that.
So we had a question here. In Europe, CSRD has just been approved to standardize ESG reporting, including an audit. Can you talk a little bit about this, and whether it's this particular strategy, or there are others around the world that are doing some of what you're looking for?
So I think we're moving for sure to the right direction, right? Because like I showed you on the Home Depot example, I mean, it's just an anecdote, right? But then, is this information correct or not is very difficult, right? To assure, right? Or to audit. So in that sense, auditors who have been in the business of auditing financial statement related and internal control related issues, I think could really add value. The question is how much resource. There has to be a lot of resources and training towards these issues, because auditors have only recently focused on assuring ESG or CSR information. If you look at the US, the market is very nascent. If you look at EU, or even in some Asian countries like China, there is more ESG related information assurance. But the problem is that most of the assurance are very at the high level, making sure the numbers are added up correctly, etc. So it's still at the very nascent stage. And in order for this to happen, the regulators obviously need to define which ESG issues are important. And firms also have to think about which of the many ESG issues they want to present and get audited or assured, right? So it's really not an not a simple and easy question, but there's no doubt that it'll be a big market. And we need people to be very well trained, I think, which is a role that academics can play, to make sure that the integrity of this information. But again, I think that if auditors, for example, step in, the value add of auditors have been, making sure that financial statement numbers are correctly represented, right? So in order to have some synergies, I think issues that are more closer to shareholder value would need to be sort of a lot of, it has to be a major portion of these reports.
Yeah, it seems like we're, inevitably going to be on a bit of a long path to get where we need to be. And there might be some interim stages where it's actually a little worse than right now, where you're getting information and it seems to be somewhat standardized, but you're still not quite sure, how much you can trust it.
Yep. Mm-hmm.
So we had a couple of interesting questions here from the perspective of managers. So, for instance, if you had an extra dollar to spend at your firm, would your best investment be in an E, an S, or a G initiative?
So this is a very interesting question. I think, so that's a hard question, right? Because so let me just sort of give you some of my anecdotal interactions with some senior managers of big companies. So first, their problem is they don't know which of these investments that they make are ESG issues. And that would likely help them, right? Because there are so many institutional investors demanding ESG performance of the firm. And I think if I take that question one step backwards, the question is which ESG investments, or which investments that firms make are ESG investments, right? So I think that's something that firm managers often think about. The issue is that they don't keep track of ESG investments ROI for the most part. So that's one thing. I think second thing is E, S, and G. People tend to think governance is a very important driver of E and S efforts that firms make. So in that sense, having robust governance, it just doesn't mean having an independent board and that's it, right? It means that, there are these firms oftentimes that are perceived as high ESG performers that are also performing very well in the stock market tend to, of course, we had a bull market run for 14 years with, tech going up and oil and gas going down for the most part up until 2022, is these firms tend to have really good culture. Right, they advocate and grow their young, junior talent, all the way up. So there are a lot of, and I view that ESG could be signal to identifying those issues. So, but I think that G is also very important, and some of these issues that I mentioned are very close to the G issues that I have in mind with respect to ESG.
So we had a question that was upvoted a bit. Do you have any insights about the relationship of ESG ratings and the actual cost of capital? Does higher ESG maturity correlate with lower costs of borrowing?
Yes. So from my research, as well as anecdotal sort of interactions, allude that ESG ratings or ESG efforts. So ESG ratings, right? We have to understand that there are these raters like MSCI and Sustainalytics that look at ESG information of the firm and put it into their model. And then they have very sophisticated models these days. And then they exercise some discretion to push out ESG ratings. So it is effectively a proxy for how much firms invest in ESG and how effective is it. So my sense from that DCF model, for example, is that firms are using ESG as a tool to reduce the cost of capital. But then, of course, you have this problem of whether ESG efforts also grow future cash flow, right? Either through marketing or many different mechanisms. So it's obviously very difficult to fully disentangle, but I think we have robust enough evidence in the academic literature as well as in the asset management and analyst industry that ESG is, at least some ESG efforts are related to value. And what drives value is the cost of capital as well as cash flow, the ability to grow their cash flow, right?
So this is a question from a more of a consumer perspective. Is it ever, do you see a trajectory for ESG in which some of this information is, at some point digestible to typical consumers? So that's another way, obviously, that we can sort of achieve certain social impact. And so I'm curious if you see any of these efforts as potentially one day benefiting consumers as well.
So I think that you mean consumer, just to clarify, consumers meaning like you and me, like the end user.
Yeah, absolutely. You and I, we want to, hey, I've got a choice to make in terms of whether I'm buying a car from this company or a car from this company. I'm going to use this information to help me make that decision as a responsible consumer.
So I think, the growth in EV, for example, could really speak to this type of question, right? I think it's an excellent question. For example, I go to a nearby Starbucks and, they have these, initiatives for their employees' education, right? And when I see that, I am like, wow, if I'm going to buy a cup of coffee from somewhere else and here and it's the same price, might as well as, drink Starbucks, given if they are the same taste or similar, right? If the quality is not compromised. So I do think that a lot of the firm ESG efforts can influence how consumers behave, how consumers consume. It's, of course, the causal direction is very difficult to tell, right? It could be the consumers driving firm ESG efforts as well, but I do think that there's a very strong correlation.
And potentially it could even one day be useful, like you could, the types of reporting that's being developed could, eventually make its way into sort of an ESG Kellogg Blue Book where you can sort of tell, okay, this is how a more structured way of making that decision.
No, I think that's an interesting point. My research is mainly focused on how investors consume ESG information, but in that sense, I think it would be a very interesting, marketing and almost sociology type of research question as well. Yeah.
So this is a question. Do you see ESG being politicized, especially here in the US? And I guess, getting at sort of your insider access here a little bit at like the board level, is this a current topic of discussion?
So at the board level, it's a very important topic. So SEC's Commissioner Allison Lee came out with a statement last year calling boards, and I'm paraphrasing, to view ESG issues as an investment activity of the firm and have a say on firms' management of ESG risk. So, she is viewing BOD members as a very important tool to, that could sort of encourage firm managers to make the right decision, right? And in terms of this. Sorry, I lost track. Your first question was?
So the question was the extent to which you think ESG is being politicized in the US.
Right, politicized, yes.
Yeah.
Oh, for sure, these days, right? I mean, we talk about some states excluding some firms and funds operating, right? And I think rightfully so, because there is accusations of greenwashing, right? Firms as well as institutional investors are being accused of greenwashing. And given sort of the uncertain and unregulated nature of ESG and ESG information, it's natural that there is room to greenwash and all these things. And I think that's the reason why both firm managers as well as asset managers in the investing space need to prioritize on focusing on ESG issues that are more closely related to shareholder value. Of course, generating impact and creating, the social capital for the society is important. But are firm managers required to do that is a very important question, right? I think they're, at least in the US, their main duty at the very high level is to deliver and create returns, right? So focusing on ESG issues that create impact as well as return, I think should be the first focus. Then I think a lot of the political debates around it, would be washed away. But because there isn't enough effort, in my opinion, to do that, there are accusations of greenwashing and anything that has ESG label can't be operating in that particular state, which I think, to be fair, I think it is the fault of folks who are in the ESG space. We need to better account for it, better, get it right, better communicate it, better embed it into our decision-making process and communicate that in order to sort of fend off some of these, issues.
How do you see companies responding to a contracting economy? And do you see the realities of the recession, either making companies sort of laser focused on these ESG activities that are going to increase firm value? Or do you see this all kind of falling apart, and maybe 5 years ago, we'll bring you on for another webinar like, hey, whatever happened to ESG investing?
So one thing that I think ESG folks, meaning, people who are generally interested in ESG, did very well is that they slapped on governance to CSR. And everything became an ESG issue. Because some people ask me, what's not ESG? If you look at it, and I think that's a fair criticism and fair frustration, right? And like I talked about in the final couple of slides of my deck, when everything's rosy and everything is going up, I can say anything I want about ESG and my ESG efforts and not being verified, and it has nothing to do with the return, and have a lot of the fluff and be okay. But I think, all of the managers that I've talked to, and if you look at S&P 500 firms, they all claim that they're engaging in some ESG issue or another, right? And that's when I think the recession actually is an opportunity for this ESG space to grow. And I personally think, and I also hope, that ESG won't go away, because International Financial Reporting Standards Board is working on embedding ESG information to actual financial reporting. So whether US will follow that and how long it will take is a question, right? It's an empirical question, but we know that at least some ESG information will be embedded into regulatory filings, right? SEC's proposal is a step towards it. So it's just a matter of time, in my opinion. So which firms do it better and why, under what circumstances, I think is the important question.
We are just about at time, so I want to thank you so much. It sounds like I will not be having you back in 5 years for the Whatever Happened to ESG webinar, but it was an absolute delight to have you on today. Thank you so much to all of our attendees, and thanks for the great questions. And we hope to see everyone again soon. Thank you.
Thank you, everyone.